Coming up in today's show, stocks climb across the board on the back of the Fed meeting yesterday. A look at what Jay said, Treasury yields drop sharply, why the bulls say the Santa Claus rally has started, why this billionaire thinks a recession is just around the corner, and the market's after hours reaction to Apple's earnings we just got. Hey, what's up guys? Welcome to the Click Capital Daily Market Show. I'm your host Jared, and if you haven't already, hit that subscribe button as I make these videos every day after close, getting you updated on the latest news, data and charts from across financial markets so we can all make better financial decisions for ourselves and our families. And apologies to my regular viewers for missing yesterday's show. Due to technical difficulties, we're all good here now, and what a bullish day on Wall Street it was. A sea of green across the board. Looks like that November seasonality is kicking in early. And even though we saw mega cap tech up again today, with Tesla up a huge 6.2%, it was the rest of the market in the equal weight indices, the Russell, that actually beat out the Nasdaq, and with some really big jumps out there with stocks that had been beaten down recently. We saw the energy sector put in a good day. Utilities were up over 2% across the board, and a big day for REITs as well on the back of the drop of yields. Dividend paying stocks had a great day, and we can see that on the chart, the S&P 500. Now climbing back above its 50-day to 43.17 on pretty good volume here, finishing the day up 1.89% and a really good bounce for the Russell here. The winning indice of the day up 2.67% again on really big volume, and looks highly likely we've put in a short-term low just here in the last few days. But the big one today is Apple, who just reported earnings. And we're currently trading down 3.2% after hours as I speak. And stick with me because I'll get into this one and all the most important charts a bit later on. So why did we have such a good rally yesterday that continued and accelerated today? Well, that was thanks to this guy here, Jay Powell, who actually came out and tried to sound hawkish. Instead, he's leaving the door open for one more rate hike, keeping an eye on inflation, etc., etc. Pretty much saying the same thing he's been saying for the last few months. The reality is the market is calling his bluff and pretty much pricing in that he is done and not going to hike rates any further. And that helped cause a big fall in yields today, which was kicked off yesterday. And yields were already pulling back yesterday before the Fed announced their interest rate decision to stay unchanged. We had some soft economic data come in. We saw the 10-year drop from 4.90 down to 4.80. Then after the Fed's press conference, we kept dropping further. And there's a look at the daily chart of the 10-year government bond yield. Fallen back a bit here to 4.66. And we've now got the 2-year just under 5%. And just looking at Fed fund futures, they're pricing in an 80% probability the Fed will stay on hold when they meet once more for the year on the 13th of December, and just given a little over 1 in 4 chance they may hike in January. However, like I've been saying for a while now, I think the Fed is unofficially on hold. They just don't want to communicate that to the market just yet. Just kind of hedging the bets in case we do get some more hot CPI numbers come in. They're leaving the door open for themselves. However, looking at the price action in stocks today, the market is pretty much saying the Fed is done. That's why we saw some huge increases in the yield-sensitive sectors and industries. So whilst we may have a bit of a roof on short-term rates around 5%, and we are getting a pullback in the long-dated durations, it doesn't mean they can't keep climbing, as the US Treasury is set to issue over $1.5 trillion in debt for Q4 and Q1 alone, representing almost 5% of the total federal outstanding debt of around $34 trillion, just in 2 quarters alone. And so the bond market is putting the squeeze on the US government, and we can already see that in recent auctions, with early signs of weakening and waning demand amongst traditional buyers of treasuries. And we also have some big structural changes in the treasury market going on as well. The first is the Fed's quantitative tightening program. That basically means they're reducing their balance sheet. For much over the last 15 years, they've been quantitative easing, printing money to buy up mostly treasuries. And that huge demand has helped keep yields low. But now they're letting those treasuries mature and roll off their balance sheet as a form of a liquidity drain, and that's weakening demand for treasuries and adding upside pressure to yields, and they're reducing their balance sheet to the tune of about $100 billion a month. The other thing we've seen over the last couple of days is the Bank of Japan, their central bank, removed the long-held 1% cap on their 10-year government bond yield, and immediately after they announced that, we shot up, getting almost up to 1%, and even though it's still really low level, just going out to a clean 1 monthly chart on the Japanese 10-year yield, you can see that steep climb it's had from negative 0.28% in the middle of 2019. And same with the Euro 10-year government bond yield and the UK as well. The more these international bond yields grow, that adds upside pressure onto US Treasury yields as well, because the Japanese have consistently been amongst the top 3 buyers of US Treasuries for decades now. And the more yield they can earn in their backyard, the more likely they're to keep a bit more money there instead of buying US Treasuries with the currency risk as well. And so the higher we go on the Japanese 10-year yield, the more pressure that's going to add to US Treasuries. and the Bank of Japan just kind of poured fuel on that fire on the back of increased inflation forecasts for their economy as well. The second biggest buyer of US Treasuries over the last 10-15 years, the Chinese government, has reduced their holdings to a 14-year low, as they, in tandem with Russia, pursued de-dollarization and trying to knock the US off its perch with its global reserve currency status. And they're still the second largest holder of US Treasuries after Japan, and they're highly likely to want to keep reducing that as a significant political goal. And that once again pulls demand away from Treasuries, which adds upside pressure to yields. And we've already had 2 out of the 3 major credit rating agencies downgrade US federal credit rating over the last 10 years, and the third one, Moody's, could follow suit as well, after S&P did it in 2011 and Fitch did it earlier this year. So all that record issuance from the Treasury, along with a degrading credit outlook, and 3 big buyers, the Fed, Japanese and Chinese, stepping back from purchasing Treasuries, that all adds significant upside to the long-dated durations. However, what could overwhelm that, at least in the short to medium term, and get yields coming back down, is if we get a recession. Like billionaire bond investor Jeffrey Gundlach says, could arrive early as next year. He went on to say, I really believe that layoffs are coming. We've seen hiring freezes, and now we're starting to see layoff announcements. They're out there for financial firms and technology firms, and I believe that's going to spread. He also said one thing that the market is going to have to confront is we cannot sustain these interest rates and this deficit any longer. We can't afford this government that we're running at today's interest rate level. It's completely unsustainable. And that sentiment's been echoed by a few billionaires of late, namely Stanley Druckenmiller, who pretty much said the same thing. However, if Jeffrey Gundlach is right and the recession is just around the corner, then the Fed will have to cut rates going into that. And that's a significant tailwind for bond prices and good for the most popular bond market ETF, TLT, which closed up today 2.2% above its 50-day for the first time since July. Again, on above average volume, and we'll just have to see whether this holds above the 50, and indeed the bond market has put in a confirmed low. We can also see high yield bonds trading really well today on strong price action. It too back above its 50 on above average volume, and a really solid sign of risk on sentiment. So yields falling back, the market calling Jay's bluff that he's on hold, the economy and jobs market holding up well, along with consumer spending, inflation outside of energy and food still coming down, and going into a bullish seasonal period of the stock market has got the bulls excited here for both stocks and bonds, with a lot of people saying this is the ideal scenario and setup, as they're both coming off a technically oversold level that seems to have found its footing, with Bank of America pointing to the fact that the economy has been resilient in the face of rate hikes, due to the fact many businesses and consumers are locked into low-cost debt, insulating the economy from rate hikes, and that the economy will slow meaningfully when rate hikes are ultimately felt, but it won't bring a recession. With BofA also saying the S&P 500 could soar 16% next year, as their unique indicator is close to a buy signal with a really strong track record. And that's their sell side indicator, which is a contrarian sentiment, which recently, as we know, we have seen a bit of bearish sentiment as the market has sold off. There's also another pattern that could signal double-digit gains next year. That's when the S&P 500 has rallied for 5 months straight this year, followed by 3 consecutive months of losses. In previous instances when that's occurred, the index posted double-digit gains a year later. And it's true, November is usually a seasonally bullish period, with that trend accelerating in recent years, as we can see in this chart here. Looking back the past 5 years, the average gain in November has been close to 4%, the past 10 years a bit over 3%, in the past 20 years and since 1950, stock market on average has gained about 1.5% in November. And looking at it another way in the current setup, when the S&P 500 has a down month in October but is still up year to date, the average gain in November is 2.4% and finishes the month higher 72% of the time. And for the final 2 months of the year, when we're up for the year but down in October, the average gain is 4.8%, with those 2 months finishing higher 89% of the time. So that's pretty strong seasonality right there. So just looking at the daily chart of the S&P 500, we started the month off yesterday at 4,200, and according to that seasonal pattern, if on average we finish the last 2 months 4.8% higher, that'll take us to around 4,400 on the S&P. So according to history, we should do something like this and then finish the year right about around here. And if that were to happen, we could get a break through the top of this trend line we started since the 27th of July on that bearish engulfing candle we got. But stick with me because I'll come back into the charts later and look at this. So we've had a really good rally across markets today, both stocks and bonds, coming into a really seasonally strong period. The economy's looking good. Oil's pulled back a little bit. A lot of inflation measures are still trending in the right path. And so there's a lot of reasons to be optimistic here in the short term going into the rest of the year. And we very well could get that rally above 4,400. However, what about the long-term setup? Especially for American stocks, which a lot of us hold in our portfolios. And if you want to see an example of US exceptionalism, look at this chart right here. of the total stock market value of the United States stock market, coming in almost at 50 trillion. That's 5 times larger than the next biggest stock market of China, even though China's economy, as measured by GDP, is only about 35% smaller than the US. And there's a couple of reasons for that huge disparity. One, US exceptionalism is a real thing. It is by far the #1 place in the world for capital. It's a very innovative and dynamic economy that easily attracts talent and capital from around the world. It does not have a financial transaction tax or stamp duties like we see in China, Germany, and other countries around the world. And on the other side of that, China is a more restrictive system, where it's kind of half communism, half capitalism, and trending in the wrong direction as foreign investors have been pulling away significantly from their market for a couple of years now. And so because the US allows the free flow of capital, is the largest economy, has strong exchanges and legal systems, along with its most important advantage, the global reserve currency status, that does deserve a premium for sure in valuations when it comes to the rest of the world. But the question is, to what point? It's not infinite. And part of the reason the US stock market has got so big compared to the rest of the world is that it has a huge advantage, and that companies with negative profit margins can still raise and maintain a lot of capital. And we can see that in this chart here. The share of publicly listed companies by profit margins. In the blue up the top, we've got very positive companies, which has been roughly about 40% of the market looking back the last 60 years. But what's changed a lot over the last 40 years is the percentage of companies with very negative profit margins below -5%. Starting around 10% in 1980, it's now above 40%. And that's something we've seen accelerate over the last couple of years, as companies don't have to make a profit and they can still attract a lot of capital in America, which gives them a huge advantage because then they can sell secondary offerings, increase the size, strength of their balance sheet, and ability to keep operating and growing. And that's something the US market allows much more than every other international stock market out there. So once again, like I said, the US deserves a premium, but the question is how much? And just looking at a long-term monthly chart of the S&P 500 going back to 2008, since we bottomed after the GFC in March 2009, the S&P 500 went up almost 6-fold, and the Nasdaq went up over 15-fold, with the Nasdaq 100 index going from 1,000 to up over 16,000 in late 2021. And just comparing that to other markets around the world, here's Canada's TSX, which did a little bit more than a 2-fold. European stocks, as measured by the ETF FEZ, have actually gone sideways that entire time. Chinese stocks are actually down in that period. Japan's Nikkei's done better, up about 4-fold, and Australia's ASX 200 a little up more than 2-fold in that time period. So American stocks, especially large technology stocks, have absolutely smoked the rest of the world stock market over the last 15 years. And we've now got the Shiller PE ratio, also known as the CAPE ratio for the US stock market, which measures the last 10 years earnings divided by the current price to give you kind of a long-term PE of the market. And that currently sits around 29, which is well above its long-term average, which is more around that 15, 17 level, and is actually at the same level we were back in October 1929 before the huge stock market crash, and the Dow Jones fell 80% over the next 3 years, leading the economy into the Great Depression for a decade. The only time we've been higher than here, apart from late 21, was in the tech bubble going into 2000. And again, the Nasdaq came off 80% over the next 3 years. And that's why we've got the bears saying the stock market still looks overvalued, even as the everything bubble deflates. And that's from Ned Davis Research, who says bonds have approached fair value after a 50% decline. And looking at valuation metrics, including a 5-year PE, shows we're still in the overbought zone. Also measured against bond yields, stocks are overvalued. And then finally, Davis pointed out US households are still overweight stocks, with nearly 40% of households owning stocks well above the long-term average of 27%. And it's true, because we have the highest 3-year change in real US household net worth, coming in at 37%, more than double the previous record. And that was thanks to a huge boom in property and stock prices after COVID, from a flood of liquidity from the Fed, government stimulus, and rock bottom interest rates. And according to John Gray, the billionaire private equity president of Blackstone Group, he still says a recession is coming in the next couple of months. As he said, I think the Fed is going to slow down the economy, and that's really their objective. They want the labor market to be less tight. They want to slow economic activity and drive prices down in the process. And the old line about you can't fight the Fed, I think that holds true. We've also got warnings from Wall Street's #1 man. JP Morgan CEO Jamie Dimon says businesses should be prepared for interest rates to go higher in case it happens. He went on to say, I think the Fed did the right thing to raise rates rapidly, and I think they're kind of right to pause here a little bit and see what happens but I suspect that they may not be done. Inflation is a little stickier than people think, and the fiscal and monetary stimulus of the last several years is more than people think. Unemployment is very low, we'll see. We've also got large retailer Target CEO saying consumers are cutting back even on food spending, but they're still healthy overall, but they're showing signs of financial stress developing. We've also got bankruptcy filings from large corporate companies, year to date through September, already exceeding most of the last 15 years at 516, so higher interest rates are starting to bite out there, but we probably haven't felt the full effects of it just yet. Moving on from economic analysis to some stock analysis, we've just got earnings results from the biggest stock in the market, Apple. We just showed another revenue decline. A lot of people don't realize this, but Apple's last couple of quarters, their sales have been down year over year. They are no longer growing, along with their guidance coming in a bit underwhelming, below expectations, and coming up short in one of their most important markets as well, China. They posted $89.5 billion in fiscal fourth quarter, and that's down from $90.1 billion a year before. China revenue came in at $15.1 billion, down from $15.5 a year before, and analysts were actually hoping for $16.8 billion there. And we saw some even larger percentage falls in Mac revenue, down to $7.6 billion from $11.5 a year earlier, and iPad down to $6.4 from 7.1. What's helped them hold up better is iPhone, with their latest release coming in. That's offsetting falls in all the other categories. And just looking at the daily chart of Apple here, we actually traded up in the regular session up over 2%, but it's going down to a 5-minute chart. Looking at after hours action, we actually almost got down 5%. We're just having a little bit of a bounce here, but we're still down 2.8%. So it looks like the market is not happy with this result. And as a result, the Nasdaq Qs are trading down 0.35% after hours as I speak. So we'll just have to see where Apple opens tomorrow. Currently trading around 172 here, back below its 50. And we'll see whether that holds or the market does a buy the dip for a bit of a clue on how the market is feeling about all this. However, outside of Apple, just looking at Q3 earnings as a whole, most companies are doing a bit better than expected. With the blended earnings growth rate so far for the S&P coming at 2.7%, analysts were pretty much expecting flatline. And there's a stark difference in companies that generate their sales inside the US. With companies that generate more than 50% of sales onshore, earnings growth rate coming at 6.8%, and companies that generate more than 50% of sales outside the US, their earnings decline coming in at negative 4.7%. And that's on the back of a strong dollar. Analysts are expecting Q4 and Q1 earnings to go back into positive mid and high single digit growth. And that's another thing given wind to the market here. Just moving on to economic data out today. We've got the Bank of England also leaving rates on hold at 5.25%. Initial jobless claims in the States coming in a bit above than expected, with unit labor costs coming in a lot lower than expected. Analysts were actually expecting a 0.7 increase, came in negative 0.8. And again, that softer economic data is helping the market say that the Fed is done and that we've likely seen the top in short-term rates. Tomorrow we've got some unemployment data coming out from Canada and the big one, non-farm payrolls in the States. Expecting to come in a lot softer than that huge growth we got in September of 336,000 new jobs. That's expected to come in at 180,000 new jobs. Along with the unemployment rate expected to come in at 3.8%, and some services PMIs we'll be looking at to finish out the week as well. Still got a lot of weak breadth measures, and that's what's keeping the fear and greed index down here at 32. In the last couple of days we actually saw a little bit of an uptick in corporate insiders purchasing stock, getting above sales for the second time in a week and a half. And we hadn't seen that since back in May, so there was a little bit of buying the dip the last few days. And we can also see that in my institutional buying percentage indicator, which went green to start the week on Monday, and that proved to be a timely signal as we've rallied up really good this week. However, my S&P 500 oscillator is almost already getting into overbought territory at 57.3. I'd say a push closer to this recent resistance just below 4,400 would have that in overbought territory. And stick with me because I'll come back to the S&P 500 at the end of this video. Just looking at other markets out there, had a huge day in Canada's TSX, up almost 3%, back above the 50 now. Another good bounce in the UK FTSE, same with German's DAX. China's market not joining in on the fun. Nikkei still looking the best of the pack, and the Aussie 200 trading back up to its 50 as well. Seen a huge VIX crush across the curve in volatility, with the main 30-day now at 15.6, and this market's gone way back to super calm and chill about it, with volatility risk premium just sitting at 1.7 points above realized. Option dealers really not too worried here. Bit of a pullback in oil volatility as well, and the market's getting really excited here with this seasonally bullish period. A lot of people buying calls now. Got the put-call ratio back down to 0.83, and was a busy day in the options market. 44.5 million contracts traded, and 54% of them calls. And the biggest one-day improvement in breadth in months here today. Now 59% of stocks above their 20-day average. Still got a bit of work to do on the long term though. Still got more stocks below their 200-day average than not. And just looking at net new highs in the NYSE, came in bullish 52 to 35, but believe it or not, still bearish in the Nasdaq, 71 new lows versus 30 new highs. And we saw a big move up today in high beta stocks, really sensitive stocks. We can see that in the spread versus low volatility, and big move up in junk bonds versus treasuries. That pullback in yield saw dollar pullback just under 106, and Bitcoin's right in the middle of this resistance zone, just below 35,000 a coin. Commodities as a whole had a good day, with gold still struggling a bit to get above 2,000 an ounce here, and crude found a little bit of footing just above $80 a barrel, and that's also helped the market a bit here. With fears of the Middle East war disrupting oil supplies kind of fading, and the market not too worried about that at all. Had a nice pop in cannabis shares, you can see that in the MSOS ETF. Bouncing off the support level. Big move up in AI stocks today. Arc Innovation was the winner, up a huge 8.4%. On the back of its biggest holding, Tesla up huge, along with a lot of other beaten down stocks. IPO sector up 3.7%. Clean energy up over 6%. Other beaten down sectors like retail back above their 50-day, up 3%. Airline companies trying to find a low here, up 3.3%. Regional banks had a great day, up 5.6%. And really good day in energy, oil and gas stocks, up over 3%. And also the yield sensitive sectors, REITs, had a really great day, up 3.1%. Back above the 50, along with utilities breaking out to monthly highs, and dividend stocks as well, up 2.2%. Big day for the BlackRock barometer, up 4.5% on huge volume. Just looking at Apple here, the latest, almost down 3% after hours. Microsoft found new highs again. Google looking to come back and try fill its earnings gap down. NVDA back above its 50, and there's Tesla bouncing right back, coming close back to its day where it fell on earnings down to 220. Really good day for meme stocks. Got C3AI up 13%, Virgin Galactic up 14%, the previous winner of the year, Carvana up 15% today, Beyond Meat up 18%, and the other EV makers doing really well. Got a bunch of earnings out today in these stocks. Standouts being Starbucks up 9.4% on their plans to open 30,000 new restaurants before the end of the decade, Shopify up 22%, and Roku up a huge 30%. And was pretty much green across the board in all the other stocks we track, with Walgreens bouncing off support here up 4.2%, and some of those vulnerable regional banks having a really good day here, along with the big guys as well. Look at those moves in Bank of America, 4.6%, Citigroup 4.4%, and Charles Schwab now back above its 50, up almost 4%. Okay, there we are on the S&P 500, 43.17, back above its 50 on good volume. A really bullish day across the board, but that wasn't led by mega cap tech. As we can see here in my composite chart, of those 8 stocks, that was actually the softest group, up 1.69%. And that's even with Tesla, which was up over 6% today. Again, the winner was the Russell, up 2.67% after being beaten down really hard this last couple of months, much more than the S&P. So there was a bit of breadth out there, like we just saw in all those beaten down sectors and stocks. And as I pointed out at the start of this video, there is a lot of bullish tailwinds for the stock market here. And the key level for me will be around that 4,400 on the S&P 500, where we've got a little bit of resistance from mid-October, and we'll be hitting the roof of that trend line started from that bearish engulfing candle. Market could get a little excited and overshoot, as it often does, and we get up to 4,500, but I would be really surprised if we can make fresh highs above 4,600 before the end of the year. And so stocks and bonds are getting excited by those lower yields and kind of developing a consensus that the Fed is done. That's pushed TLT back above the 50, and we'll be keeping a close eye on that to see whether that can hold. And that 10-year yield pulling back to 466 really helping things, along with the biggest variable in inflation, cost of oil and energy helping things as well, pulling back. And that's why we've got the VIX nosediving. Everything is looking good here for stocks in the short term, and we'll just have to wait and see how the market reacts to Apple tomorrow. Currently down 3% after hours, and whether that'll drag down the market and we get a reversal, because we've also got the Non-Farm Payrolls report looking at the jobs market, and we'll see whether the stocks can hold on to these gains going into the weekend. That's all for today. Thanks very much for tuning into the Click Capital Daily Market Show, and I'll see you again tomorrow afternoon. Cheers.